Hello everyone. In this fourth session of Money and Banking, let us discuss about the credit creation by banks. Before we move towards the credit creation, let us see about the present rates. The first one is cash reserve ratio, that is 4%. All the commercial banks are supposed to keep 4% on their deposits at Reserve Bank. The SLR is 19.25%. All the commercial banks are set to reserve 19.25% on every deposit as SLR in their particular vault. The third one is bank rate, that is 6.5% at present. That is the lending rate for long-term loans from RBI to the commercial banks. And repo rate is the short-term loan lending rate from the RBI to the commercial banks, and that is 6.25%, and reverse repo rate is 6%. So, reverse repo rate, as all of you know, that is the lending rate of commercial banks to the RBI, or the RBI collects the extra money, that is the over inflow in any particular commercial bank, and it keeps it in Reserve Bank of India, and it is a quantitative measure to bring the money supply in the economy. Now let us see about the credit creation. The credit creation is done through money multiplier or credit multiplier. Money multiplier is nothing but it is the amount of money that the banks are able to create in the form of deposits with every unit of initial deposit. So, the amount of money that any particular commercial bank is able to generate or create out of every initial deposit, because on each day the bank is supposed to get the deposits, and on each day the bank is going to give loans to the public. So, on every initial deposit, how much money is regenerated or recreated by these commercial banks, and how much money is earned, that is in the form of credit creation. So, this is known as the money multiplier. The formula is 1 divided by LRR. This money multiplier is also called as credit multiplier. So, this is done from the initial deposit only. And now let us see how the money multiplier works, or how the credit is created out of every initial deposit from a commercial bank. These commercial bank create money out of two types of deposits. The first one is primary deposit and the second one is secondary deposit. There are two types of deposits, that is the first one is primary deposit and the second one is secondary deposit. The primary deposit says that the initial amount that a bank gets out of the deposit, and the secondary deposits are those which are the deposits created out of the loans that are given from the initial deposit. So, the initial deposits are called as the primary deposits, and the secondary deposits are the deposits that are generated out of the loans given to the public from the initial deposit. So, now let us see how the credit is created from these primary deposits and the secondary deposits. If a person enters to bank and deposits rupees 1000 in any of the commercial bank, this is called as the primary deposit or the initial deposit, and out of this 20% is deducted, 10% for CRR and 10% for SLR, that is cash reserve ratio is 1, that the out of this initial deposit that this particular commercial bank is supposed to keep in the Reserve Bank. So, out of this 10% is, that is 100 is kept in Reserve Bank of India as CRR, and 10% is kept in that particular bank only in its vault, either in the form of government securities or in the form of cash or gold. Even it can be kept in the form of gold too. So, this is again 100 rupees. So, this 200 rupees is deducted out of the initial deposit and rupees 800 is available now. This 800 is given to A, B, C, these three persons as loan. So, these persons avail loan. Out of this 800, all these three persons avail loan individual according to their need, and this loan amount is credited to their individual accounts only. And here again the same money returns to the same bank to these people's account. So, again out of this 800 rupees, 20% is deducted as CRR and SLR. So, 160 rupees is deducted out of it. Rupees 640 is available again with the bank. Again this rupees 640 is given to DEF. These three persons. Again this 640 is given to DEF in the form of loan, and this 640 is again will reach the bank in the form of check only, because those who avail loan, they do not eat that money and waste it. They keep it in their particular account only to pay the checks to their clients. So, therefore, this 640 again is deducted with 20% as CRR and SLR, 10% for CRR and 10% for SLR. So, what happens? 128 rupees is deducted again from rupees 640, and rupees 512 is available with the bank. Again, this 512 rupees are given to GHI, another three persons in the name of loan. Again these three persons get this money to their accounts only. So, naturally the same bank gets money repeatedly. So, like this, the money out of rupees 1000, bank has multiplied money by out of this 1000, the bank has multiplied money thrice, that is 800, 640, 512, and after every secondary deposit, that is the money created out of the loan issued from the initial deposit, the commercial bank earns money and it makes profit. So, in this way the commercial banks create money. This is known as credit creation. In this way the commercial bank makes money and it helps the economy to move. Public go to the bank and they avail these loan facilities and buy the necessary goods and services. So, if the loan is given in excess, the demand for the product increases as well as the price also hikes. So, this is a harmful situation for the economy. As well as if the loan is not given to the public, naturally the demand for the product reduces and the price will fall. Again, this is also harmful for the economy. So, to control this, the RBI maintains different types of qualitative and quantitative measures, and it controls the money supply in the economy and brings down the situation of inflation under control. So, when we think about the credit creation, there are two assumptions for this. The two assumptions of credit creation or the multipliers are that each and every commercial bank in this country is treated as one, because if a person avails loan from one particular bank, that loan is again credited to his account only. Mostly it is to the same bank account only or to any other bank in which he owns his account. So, therefore, all the banks in the country are treated as one only here. And the second assumption is that all the receipts and payments are made by check only, and there is only less of cash transaction. So, these two assumptions help the money multiplier to generate income, and out of this credit multiplier only the banks earn money in the name of interest. So, for giving every amount of interest, for getting 1000 rupees, the commercial bank gives interest to this person at 4% at once only, for only one person. But For every repeated issuing of loan, bank charges a minimum of 14%. I am giving this as example. A minimum of 14% of interest, and with this 1000 rupees, how many times 14% interest is earned on different amounts because of the regeneration of the or recreation of the deposits out of the loans issued out of the first initial deposit. This is the way how the credit multiplier works. ಒಂದು ಸರ್ತಿ ಬ್ಯಾಂಕ್ ಒಬ್ಬ ವ್ಯಕ್ತಿಯಿಂದ 1000 ರೂಪಾಯಿ ಠೇವಣಿ ಹಣವನ್ನು ಪಡ್ಕೊಂಡ್ರೆ ಅದರಲ್ಲಿ ಅದು CRR ಅಂತ 100 ರೂಪಾಯಿ ಹಾಗೂ SLR ಅಂತ 100 ರೂಪಾಯಿ 10% ಆ್ಯಂಡ್ 10%. ಅದನ್ನು ಡಿಡಕ್ಟ್ ಮಾಡಿದರೆ 200 ರೂಪಾಯಿ ಕಳೆದ ನಂತರ 800 ರೂಪಾಯಿಯನ್ನು ಅದು ಈ 3 ಜನರು A, B, C 3 ವ್ಯಕ್ತಿಗಳಿಗೆ ಸಾಲವಾಗಿ ಕೊಡುತ್ತೆ. ಆ ಸಾಲದಿಂದ ಮತ್ತೆ ಆ ಸಾಲದ ದುಡ್ಡು ಅವರ ಅಕೌಂಟ್ಗಳಿಗೆ ಹೋಗುತ್ತೆ. ಆ ಬ್ಯಾಂಕಿನಿಂದ ಹೋದಂಥ ಆ ಹಣದಿಂದ ಮತ್ತೆ 20% CRR ಮತ್ತು SLR ಕಟ್ ಮಾಡಿದರೆ ಮತ್ತೆ 640 ರೂಪಾಯಿ ಬ್ಯಾಂಕಿನ ಬಳಿನೇ ಉಳ್ಕೊಳ್ಳುತ್ತೆ. ಸೊ ಈ ಉಳ್ಕೊಂಡಿದ್ದಂಥ 640 ರೂಪಾಯಿನ ಮತ್ತೆ DEF ಈ 3 ಮಂದಿಗೆ ಸಾಲವಾಗಿ ನೀಡಿದರೆ ಆ ಸಾಲದ ಹಣ ಈ DEF ಅನ್ನೋ 3 ಮಂದಿ ಅಕೌಂಟ್ನಲ್ಲೇ ಬಂದು ಸೇರುತ್ತೆ. ಹಾಗಾಗಿ ಈ ಒಂದು ದುಡ್ಡು ಮತ್ತೆ ಅದನ್ನು ನಾವು ಅದೇ ಬ್ಯಾಂಕಿನಲ್ಲಿ ಉಳಿಸ್ಕೊಂಡು ಅದಕ್ಕೆ 20% CRR ಮತ್ತು SLRನ ಕಟ್ ಮಾಡಿದರೆ ಆಗ ಬ್ಯಾಂಕಿನ ಹತ್ರ 512 ರೂಪಾಯಿ ಮತ್ತೆ ಉಳಿದು ಅದನ್ನು ಇನ್ನೂ ಉಳಿದ ಒಂದು 3 ಜನರು GHI ಈ 3 ಜನರಿಗೆ ಸಾಲವಾಗಿ ನೀಡಬಹುದಾಗಿದೆ. ಸೊ ಈ ಒಂದು ರೀತಿಯಿಂದ ಬ್ಯಾಂಕ್ಗಳು ಹಣವನ್ನು ವೃದ್ಧಿ ಮಾಡುತ್ತೆ. ಈ ಒಂದು ಸ್ಕೀಮ್ಗೆ ಮನಿ ಮಲ್ಟಿಪ್ಲೈಯರ್ ಅಂತ ಹೇಳ್ತಾರೆ. ಸೊ ದ ಫಾರ್ಮುಲಾ ಟು ಕ್ಯಾಲ್ಕುಲೇಟ್ ಮನಿ ಮಲ್ಟಿಪ್ಲೈಯರ್ ಈಸ್ the 1 divided by LRR. The formula to calculate the credit multiplier or money multiplier is 1 upon LRR. The LRR is the legal reserve ratio. It is comprised by CRR as well as SLR. So this is the way how a commercial bank generates money through the initial deposit. So with this I conclude this session, and in our next session let us discuss about few more topics of the same lesson. Thank you.